Hello viewers, welcome to my channel. I'm Hasham. So far 9 problems I have completed on problems on capital budgeting. So in this video, one problem, 10th problem. It's a lengthy problem in which we have all the different methods, techniques of evaluating capital budgeting proposals. I'm going to explain. So if you want the perfect knowledge, watch all the videos from beginning till end. And if you have not watched the theory videos, I suggest you go to the playlist of my channel. Select the subject, financial management for BBA. Select the video of capital budgeting theory. Be perfect about all the techniques. That means the traditional technique, PBP and AR, and the modern techniques, discounted techniques, that is NPV, PI and IR. So if you have watched the earlier 9 problems, I think you are in a position to understand and calculate the PVP, ARR, NPV. So in this problem, 10th problem, all the different methods I'm going to explain. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take the screenshot of the points which I have written on the board, then I'll explain. Come on, see the 10th problem. A company is considering investment proposal to purchase a machine costing 2,50,000 with an estimated life of 5 years. The initial investment or cash outflow is 2,50,000. Life of the project is 5 years. Following are the estimated cash flows before depreciation and tax. So for calculating PBP, NPV, IRR, we need cash flow after tax. But in this problem, the new point is cash flow before tax is given, CFBT. We have to convert this into CFAT, cash flow after tax. That is called cash inflows. So first year, second year, up to 5 years, cash flows are 60,000, 70, 90, 1 lakh, 1,50,000. The company is in tax bracket of 40%. And uses straight line method of depreciation. Cost of capital 10%. You are required to evaluate the project under payback period method, rate of return method, that means AR, then net present value method and internal rate of return method. So almost all 4 methods we are going to do in this problem. The new point CFBT is given, right? And depreciation is to be calculated on straight line method. The formula for calculating annual depreciation is cost minus scrap divided by life. The scrap value is not there, so 0. So simply we will take cost divided by life of the project. The cost of the project is 2,50,000. Life is 5 years. So 2,50,000 divided by 5. You will get 50,000 depreciation annual. So while watching the video, I suggest always keep a notebook, calculator, pen ready. Whenever I explain something important, note it down. That will help you to understand and remember the technique. Now, first of all, calculation of CFAT. By preparing this table, we can convert CFBT into CFAT. First year 1, 2, 3, 4, 5, CFBT, cash flow before tax. So these are the values given. And annual depreciation. So annual depreciation as per SLM, straight line method. So cost minus scrap. There is no scrap. So 2,50,000 by 5, 50,000. Every year the depreciation remains same, straight line. So 50,000 every year. Now deduct depreciation, will get profit before tax. So 60,000 minus 50,000, 10,000. Then 70,000 minus 50,000, 20,000. These are all the PBT, profit before tax. The tax rate is given in the problem 40%. So calculate 40% of 10,000, 4,000. 40% of 20,000, 8,000. 40% of 40,000, 16,000. Like this. PF, now this is a tax. Now PBT minus tax, will get PAT, profit after tax. 10,000 minus 4,000, 6,000. 20,000 minus 8,000, 12,000. These are the PAT. But we need CFAT. For calculating CF80, we have to add back depreciation. Remember, the profit is not the cash inflows. So we have to, remove the effect of non-cash transaction. The non-cash transaction is depreciation. So add back depreciation to PAT, we will get CF80. So PAT plus depreciation. 6,000 plus 50,000, 56,000. 12,000 plus 50,000, 62,000. 24,000 plus 50,000, 74,000. Like this, we got CF80, cash flow after tax. Now take the total, 382,000 is the total of CF80 and 1,32,000 is the total of PAT. These are the basic calculations we require for applying the different techniques. So first we will calculate payback period. This is a simple method of evaluating capital budgeting proposal. Payback period is the time required to get back our initial investment. So here CF80, 56,000, 62,000, 74,000, all this CF80. CF80 is nothing but cash inflows. Now, cumulative CF80, cumulative cash inflows. So first year 56,000 same. So 56,000 plus 62,000, 118,000. 118,000 plus 74,000, 1,92,000. 1,92,000 plus 80,000, 2,72,000. Plus 1,10,000, 3,82,000. These are the cumulative. Now locate in the cumulative cash inflows 2,50,000. Our cash outflow is 2,50,000. So locate 2,50,000. We don't have 2,50,000. We have 1,92,000 and 2,72,000. 1,92,000 is less than 250 and 272 is more than 250. So our PBP lies between third year and fourth year. That means complete 3 years plus a portion of the fourth year, a part of the fourth year. How much part? We have to calculate like this. So initial investment 2,50,000. Now 1,92,000 is received up to the end of third year, right? Up to 1,92,000 up to third year. Now how much still we require? So 2,50,000 minus 192,000, 58,000 we still require in the fourth year. So fourth year, what is the cash inflow? 80,000. So out of 80,000 we require 58,000. The proportion will be 58,000 by 80,000. 58,000 by 80,000. It comes to 0.725. So 3 complete years plus 0.725 year. That is the fourth year. So PBP will be 3 plus 0.725 is 3.73 years. So this is the method of calculating payback period. So one technique we have completed. The second technique is accounting rate of return or average rate of return. The formula for ARR is average profit divided by average investment into 100. So two things we require: average profit. Profit means accounting profit, not cash inflow. That point you have to remember. Only for calculating ARR, we need accounting profit rather than cash flow. Whereas PBP method, NPV method, IRR method, we require CF80. But here we require PAT. Average PAT means the total PAT divided by number of years. What is the total PAT here? 1,32,000 in 5 years. So 1,32,000 divided by 5. 26,400, that is the average profit. Now average investment. The formula for average investment is cost of the project minus scrap value divided by 2. But we don't have the scrap value. And after that we have to add back scrap value plus working capital. This formula already I have explained in the theory video. So that's why I am saying, before watching problems, be perfect about the theory. We don't have working capital, we don't have scrap value. So simply cost divided by 2. 2,50,000 divided by 2. 1,25,000 is the average investment. Now substitute average profit by average investment. That is 26,400 divided by 1,25,000 into 100 percentage. So it comes to 21.12%. This is the accounting rate of return. So two methods we have completed, payback period method and AR method. The third method is NPV, net present value. So we need present value of cash inflow minus present value of cash outflow. Outflow is given in the problem, initial investment 2,50,000. We need present value of cash inflows. So year 1 to 5 and CFAT already we have calculated 56,000, 62,000, 74,000, 80,000, 1,10,000, right? Now this we have to multiply with PV factors. The PV factors will not be given. Sometimes it will be given in the problem, but many times it may not be given. In that case, you have to refer the present value table. This present value table tables I already uploaded in the description. So in the description, you can find the problems and the present value tables. So present value tables, you can see here. This is the present value of annuity. And this is the present value of rupee 1. We don't want annuity. Annuity will be used when constant cash inflows are there. But here it is not annual but rupee 1. Present value of rupee 1. 10%, first year 0.909, second year 0.826, third year 0.751, 683, 621. These are the present value factors at 10% rate and for 5 years. Now, 0.909, 0.826, 0.751, 683, 621. Multiply the CFAT with PV factors. So 56,000 into 0.909, 50,904. 62,000 into 0.826, 51,212. Like this, you multiply all the CFAT with PV factors and take the total. The total of PV of cash inflow is 2,80,640. This is the present value of all cash inflows which we are going to get in 5 years. So PV of cash inflow 280,640 minus present value of cash outflow, that is initial investment 2,50,000. Subtract 30,640. This is the net present value, NPV. 3 methods I have explained, that is PBP method, ARR and NPV. The next is IRR, internal rate of return. IRR means that rate at which the present value of cash inflow and present value of cash outflow both are equal. Now here you need some practice because it's a little bit complicated compared to other methods. This is a little bit complicated. So you have to remember the steps required. Calculation of IRR. Since the annual cash inflows is not constant, so we calculate fake PBP. First of all, you have to see whether annual cash inflows are constant or not constant. Here it is not constant. Every year CFAT is different. So we need fake PBP, imaginary PBP. The formula for actual PBP is initial investment divided by constant annual cash inflow. But here it is not constant. So formula for fake PBP, initial investment divided by average cash inflow. Average cash inflow. So average cash inflow. What is the total cash inflow of 5 years CFAT? You can see 3,82,000. 3,82,000 is the total cash inflow for 5 years. Right? We need average. So divided by 5. 3,82,000 divided by 5, 76,400. Now 76,400 is the average cash inflow. Now fake PBP is equal to initial investment 2,50,000 divided by 76,400. You will get 3.272. 3.272. Now next step is in PV of annuity table. Again you have to refer the table. This is PV of annuity, PV of annuity. 2 tables are there. Present value of rupee 1 and present value of annuity. Now you have to refer the annuity table. Again, the life of the project. The life of the project is 5 years. So in annuity table, in the line 5 years, locate a factor nearest to 3.272. Nearest. That means either less than or more than, doesn't matter. But it should be nearest to 3.272. So here it is PV of annuity table. Here PV of annuity table. You can see here from first year for 1%. 4.853, 4.713, 4.580. Like this, if you go, you will find how much we want, 3.272. So 10% is not there, come to 15%, 16%. At 16%, you can see 3.274. 3.274 is very near to 3.272, right? So our starting point is 16%. We begin our calculations at 16%. So at 16% we will calculate what is the NPV. Because one NPV already we have. At 10% rate, our NPV is 30,640. Now we calculate NPV at 16%. So here, CFAT is given 16%. Again, refer the present value of rupee 1, not annuity. Present value of rupee 1 at 16% for first year is 0.862. For second year, 0.743. You have to refer the table. Then 0.641, 0.552, 0.476. Now multiply the CFAT with PV factors. You will get PV of cash inflow. The total of PV of cash inflow, 2,38,292. Now PV of cash inflow, 2,38,292 minus PV of cash outflow, that is 2,50,000. So it comes to negative minus 11,708. So one NPV positive, another NPV negative. 10% we got positive NPV 30,640. At 16% negative NPV minus 11,708. That's what we want. One NPV should be positive, the other NPV should be negative. Our IRR lies between these two rates, 10% and 16%. In between these two rates lies our IRR. So at 10% rate, positive NPV 30,640, at 16% negative minus 11. So therefore IRR lies between 10% and 16%. Actual IRR can be calculated by the following formula. Now record, note down this formula. IRR is equal to RL plus NPV L. L stands for lower rate divided by difference in NPV. What is the difference between these two NPVs, right? Into delta R. Now what does it mean? RL is equal to lower rate. The lower rate is 10%. 10% is the lower rate, right? And NPL, net present value at lower rate. At lower rate 10%, the NPV is 30,640. 30,640. Delta R is the difference between the two rates. The two rates are 16% and 10%. So 16 minus 10, 6. That is the delta R. Now IR is equal to, in place of RL, write down 10. In place of NPVL, 30,640. Now difference. First you take positive value. The positive value is 30,640. I have taken. Now minus. Then you have to take the other NPV. The other NPV is negative. Negative is minus 11,708. Minus 11,708. Now open the bracket, minus into minus will become plus. So minus into minus will become plus. 30,640 plus 11,708. If you add up these two, 42,348 into 6. So now multiply 30,640 into 6 divided by 42,348. You will get 4.34. Now add up. 10 plus 4.34, 14.34, that is the internal rate of return, IRR. That's all. So in this problem, 4 methods I have explained. How to calculate the PBP, how to calculate ARR, how to calculate NPV and IRR. So if you want the complete command, Watch the video not once, twice, thrice. Make note, calculate yourself. Then only you can be able to understand, you can enjoy learning, and with confidence you can write in examination. Simply watching the video, listening the lecture will not matter, will not help you. So that's why remember my words, remember my suggestions, follow it. Definitely you will benefit a lot from these videos. I'm putting my 100% to explain each and everything. So give your comments from where you are watching, from which city, which country you are watching. Just give it in my comment so that I can be able to know from which countries my channel is being watched, my videos are being liked. So if you are satisfied, give a like to the video. Share my channel among your friends, among your groups, so that more students can watch the video and get the confidence on the subject. Inshallah, we will continue in the next video.